Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by my colleague, Gabriele Gramazio, from our Structured Credit Rating team. We'll be covering the topic of European CLO managers and the different styles of portfolio management, as outlined in our CLO Manager Style Comparison reports, which can be found on our website. An individual collateralized loan obligation manager's style or approach to investing in a pool of leveraged loans can vary compared to peers. In the end, it is investors who determine which manager's approach best suits their needs. In our CLO Manager Style reports, KBRA examines cross-metric comparisons that could offer insight on potential strategies employed across the market. CLO manager styles are classified into opportunistic and conservative. However, these classifications are not intended to imply any positive or negative sentiment. Rather, they're being utilized for information purposes to display and distribute the data and an analysis of the manager's style. Gabriele, I have just provided a very high-level view of the manager style report, but perhaps you can give us a bit more detail into the way we have come up with the analysis in this report.
Thank you, Gordon. Yes, in order to illustrate different management styles in a way that avoids a rigid top quartile, bottom quartile assessment, which tends to be prevalent approach in the market, we have utilized cross-comparison metrics to evaluate CLO manager styles. Our evaluation comprised 4 stages. The first one, several metrics were chosen from reported information, including, for example, the weighted average spread, which provide information on the spread levels of the loans and bonds within the pool. This is calculated into a weighted average for the manager from the various outstanding transactions they are managing based on the current collateral balance. Second, we then selected 10 pairings of these metrics. For example, the weighted average spread, the WAS, and the percentage of the loans rated CCC or lower. Next, these 2 metrics are plotted into a chart with one metric on the x-axis and the other on the y-axis. For example, the weighted average spread on one axis and the KBRA weighted average rating factor or WARF, a KBRA calculated metric essentially. So you can find information on the K-WARF and how it is calculated on our website. So both the axes are set to cross at the metrics mean, creating a visual with 4 regions. Each of these 4 areas represents a broad strategic approach. The first one is conservative, the second one moderately conservative, then you have the moderately opportunistic, and the last one, which is the opportunistic. Where a manager falls within these categories is based on their values for each metric.
Thanks, Gabriele. That's very interesting. So how do you get a complete representation of a CLO manager's style from this?
Some of these metrics and cross-metric comparisons on their own may not present a full picture of a manager's style based on the information represented. For example, a loan purchase could be mispriced or purchased at an extreme event. For instance, the COVID-19 pandemic. That was particularly true for fixed loans that we have seen in the past several months. Or perhaps it was priced at the low spread because the market was very competitive at that time. So effectively, there are many nuanced elements in the metrics reported, which is why we have chosen to gather the information from 10 cross-metric comparisons to counter any weakness in a single metric. We take a total of 10 cross-metric comparisons that we then compile to create an aggregated illustration of the broad approach taken by a CLO manager. Their position across the various metrics provides a greater insight into an individual manager style rather than relying upon just one individual metric to define a manager. We find the use of the analysis of multiple metrics gives a better representation of style rather than, for example, just evaluating a manager based on the number of loans within a CCC bucket.
I agree, especially given I was involved in the creation of it. So let's get into a bit more detail. How do you get to define a manager as an opportunistic or a conservative manager?
So we utilize a CLO Manager reported information for each transaction in their portfolio. As mentioned, we then derive a weighted average across the manager's transaction to create one number for a CLO manager for a given metric. This number was then plotted on the x-axis, and another of the manager weighted average metrics determined the relative location in the y-axis. The chart was divided into four by plotting the x-axis along the mean of all manager for one metric, and the y-axis along the mean of all the manager for the other metric. This provided a chart split into four boxes or quadrants. A manager who fell below the average in both metrics would appear on the bottom left quadrant, while a manager who is above the average in both metrics would appear on the top right quadrant. Those with a higher than average metric for one metric and lower than average metric for another would fall into either the top left or lower right quadrant. From this classification, we take a weighting of each cross-metric comparison and then rank European CLO managers by the number of cross-metric comparisons falling within the various categories. We use a weighting of 4 for an opportunistic strategy, 1 for conservative strategy, 3 for moderately opportunistic, and 2 for moderately conservative. Therefore, a manager with 4 cross metrics falling under opportunistic may be ranked as more opportunistic than one with 5, if they also have a high number of moderately opportunistic comparisons.
Thanks. Can you give us a bit more detail on what is considered a conservative manager?
Well, a manager could be considered conservative if metrics in a cross-metric comparison are below average. In a chart, this manager would appear in the bottom left quadrant. So, for example, they could have a below average WAS, weighted average spread, suggesting that they are managing a portfolio of collateral with low spreads relatively to the market. When this is compared to the percentage of the portfolio with collateral rated CCC or lower, if they also have a below average level of CCC rated collateral, they would then be below average in both metrics, and viewed to have a conservative approach for that particularly cross-metric pairing.
And the same for opportunistic, or the opposite, I should say, for opportunistic?
These managers fall into the category of above average in both metrics, so appearing in the top right quadrant. The transaction metrics indicate a more aggressive approach than their peers, and as a result have higher levels than the rest of the market in both of the compared metrics. For example, a manager that has a high average K-worth for the underlying loans would be holding loans that are considered to be of a higher risk level than others. Similarly, if these loans also have a high weighted average spread, a manager may be targeting these types of loans for the higher yield, but they would also be taking on greater levels of risk as implied by the higher spread level. Therefore, a manager with both high K-worth in the portfolio and a high weighted average spread would be considered to be pursuing a more opportunistic approach.
Right. And lastly, how do you then classify those that fit into the middle?
Well, managers who are below average in one metric but above average in another are perceived to have a more moderate approach. This is further broken down into either moderately conservative or moderately opportunistic. This distinction is based on the metric chosen and its contrasting metric. On a chart, these will fall into either the bottom right corner, moderately conservative, or upper left corner for the moderately opportunistic. Using our previous example, we have chosen to weight a higher K-worth as more opportunistic than a higher weighted average spread. As a result, those that have a high K-worth but low spread levels are considered to be moderately opportunistic. In contrast, those that have a low K-worth but a high spreads level are considered to be moderately conservative.
Thank you, Gabriele. That explains everything very well. Perhaps you can take us through a selection of some of the 10 individual cross-metric comparisons. Let's start with the K-worth versus weighted average spread as you've used in your example.
A weighted average spread could be taken as a view of the relative risk of the portfolio, with higher spreads potentially suggesting higher compensation demanded by investors to extend the loans. The KBRA weighted average rating factor is also a view of the relative credit quality of the underlying assets in the portfolio. Therefore, a higher K-worth would suggest lower credit quality for the assets in the portfolio. A WAS and a K-worth should go hand in hand, but due to issues of timing, downgrades, or trading activity, this relationship can change. Various strategies could be deployed to reach the final result of the different metrics, or circumstances could have impacted the portfolio for these metrics. Those with high WAS and high K-worth are potentially operating with a more opportunistic risk/reward approach within their portfolios and therefore appear in the upper right quadrant.
Great. So then what if we were to compare the KBRA weighted average rating factor against the total equity yield?
The total equity yield is the annualized yield provided to the equity holders as per dividend distribution. This is calculated by taking all the payments made to the equity tranche to date, dividing by the original equity balance, and then annualizing the total payment over the number of days from issuance. One hypothesis for this pairing is that a manager who decreases the relative credit quality in the portfolio, in theory, should also be able to produce a higher level of yield to equity investors, assuming they are being compensated for taking obviously this additional credit risk. For example, these may be achieved as they opportunistically invest in rising stars, whose credit quality is expected to improve over time. If the credit quality of these loans does improve, and they are either paid down, refinanced, or traded at a higher price than which they were acquired, then the manager could have additional cash flows to provide dividend distribution to equity holders. As a result, managers with a high equity yield and high K-worth have allocated a position in the top right quadrant and classified as opportunistic.
If we then take that equity yield and compare that with something called a par build, what do we get?
Yeah, par build is a way for managers to increase the overall value of the portfolio and credit enhancement for investors. Par build is calculated from the first update or deal closing date, and it is the increase in collateral balance during their investment period. For example, a value of 102% would indicate that the manager has added 2% more collateral to the deal based on the loan par balance. This is only calculated during their investment period, so may be excluded from a manager average if they have transaction whose investment period has ended. This has been compared with the total equity yield, which is an annualized rate of return for equity holders, as mentioned already before. Par building may be larger in transactions that have been outstanding for longer, obviously, as the manager will have had longer time to trade into transaction below par and out of transaction at or above par. This may be in contrast to a manager who looks to distribute all excess funds to equity holders and maintain a high equity yield. The top right quadrant highlights those managers that have been able to build par and also achieve a high equity yield.
And next up, we compare equity yields with equity leverage.
Yes, one method of achieving high levels of equity yields is to utilize obviously high levels of leverage. So we compared total equity yield against the level of equity leverage and found that a manager with a high level of equity yield but a low level of leverage could be considered to be more balanced. However, an opportunistic approach could be one that strives to maximize yield with high levels of leverage. As a result, a high total annualized equity yields versus high levels of leverage to achieve that yield would fall into the upper right corner as a more opportunistic approach.
CLOs are made of traded collateral, so the value of these underlying assets can change. This type of metric is also included in the analysis, correct?
Yeah, while CLOs are not market value vehicles themselves, market value over collateralization at the AAA rated tranche level is a measure that is often evaluated by investors to determine the relative health of a given CLO tranche from a current value of the underlying collateral perspective. So as a result, this current value of the pool and the protection offered to senior note holders is then compared against the manager's ability to also provide the other side of the capital structure, the equity holders with a high level of yields. Managers with a high level of market value protection for senior note holders as well as high yields are classified as opportunistic in their approach. So to some extent, this is aided by the amortization of the senior notes over time, which does present some managers with exceptionally high weighted average levels of over-collateralization at the top tranche level.
Thank you very much, Gabriele. We will save our audience from hearing about all 10 cross-metric comparisons, but if they go to KBRA.com, the report and detail of all these metrics can be found in full. Now let's dig a bit deeper into the results. So we have just updated the results for as of January. Who are the managers that have tended to come up in the more opportunistic side?
So in our latest report, we outlined 10 managers in Europe that have tended to lean on the opportunistic side in the management style. And these include CBAM, PGIM, Capital 4, Invesco, Angela Gordon, amongst the others. These 5 have tended to remain within the top ranking of more opportunistic managers across the 3 reports we have produced, with the exception of Capital 4, which moved into the top 10 in September. All of these 5 fall into the opportunistic camp for at least 5 of the cross-metric comparisons, and only 2 of the manager, which are PGIM and Angela Gordon, have one of the cross-metric comparison classified as conservative.
That's very interesting. What about on the more conservative side? How have the managers broken out on that side of the market?
Here, there is a much more concrete grouping of conservative cross-metric segmentations. All of the 10 most conservative managers have no instances of falling into an opportunistic quadrant. The 4 most conservative managers, Redding Ridge, Alcentra, Ostrom, and CIFC Asset Management, all fall under the conservative camp in 8 instances of the cross-metric comparisons. The biggest changes here came from Ostrom and CIFC, which were more in the middle of the pack in the past reports, but have migrated to the more conservative end of the spectrum. However, Redding Ridge, Alcentra, and another couple in the top 10, TKO and CVC Credit Partners, have consistently been amongst the most conservative managers.
Thank you, Gabriele. That is very interesting and definitely a worthwhile report to take a look at, especially given the number of charts involved.
Yes, it is also interesting to note that many managers that we have spoken with are in agreement with our analysis of their style as conveyed in the report.
Great, thanks again. So in conclusion, the research provides insight into potential CLO management styles for the broader marketplace, as they are based on as many as 10 objective cross-metric pairings. KBRA's classification of manager styles offers another layer of insight into an investor's evaluation of the market by looking at the various managers and how they approach their portfolios. As markets move, managers are reacting to the current environment, and as a result, we will start to see the impact of these different styles. KBRA are actively monitoring the situation, as always. Make sure you are registered on our website, kbra.com, have subscribed to our podcast, and of course, are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Stay strong out there. as we navigate through the challenging environments ahead.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.